Have you been holding, buying more, or maybe selling some Apple and taking profit?
Well, as you can imagine, it's a pretty full position. It's a stock that we've owned now since 2005. So we did benefit from that 7-for-1 stock split 6 years ago, as you mentioned. So the 4-for-1 stock split is certainly welcome news. At the end of the day, though, it doesn't really change the valuation of Apple. It just makes the shares more maybe appropriate for smaller investors and broadens out the shareholder base. Hard to say that it's a narrow shareholder base at this point, though.
Well, how much of this run the last few days, not this year or over the past 12 months, the last few days, Tim, do you think is split related versus just renewed optimism over Apple or Fed-led stimulus that's got to go into something?
I think it's probably the latter, where there's money flowing into the market, and as it flows into the market, it flows into tech funds and index funds. And as Apple has grown larger, it sees a larger share of those index funds. So it becomes a self-fulfilling prophecy when you get to this size of the S&P 500. When you represent 6% of the index, you're going to continue to see your stock go up. That can be a double-edged sword, though. Should sentiment in the market go down, Apple will suffer along with it.
Maybe we'll call it the Yogi Berra market. Nobody goes there anymore. It's too crowded. I mean, that's, you know, our viewers have probably wanted to reach through the screen and sort of throttle me for saying this over the last year and a half, Tim, where I've been talking about this narrow market and how sort of the way that the ETF and index fund structure is structured could lead to these market gains because the way that you buy and sell ETFs and index funds, and it's beautiful when it works. You referenced the chance, I guess is the right word, of what happens if it doesn't. So what happens if what's working suddenly stops?
Well, I think there's two schools. I think the hope for investors is the rest of the market begins to catch up to the 5 or 6 stocks that have been driving the market. And I think that's really going to depend on progress on the virus and progress in the economy. The downside is if it's just simply sentiment, as the market goes down, you're going to see the largest components of the indices get hurt the most. For Apple, it's got such a broad shareholder base, we don't think it would be as devastating as if it were an entirely institutionally held asset. But you know, what brings you up also brings you down. What we have to pay more attention to is valuation. And 30% in the stock over a really short period of time starts to tell you that perhaps a little bit of froth is building up within the stock.
But why would valuation matter when it's just index and ETF funds for the most part, right? They don't care. Right. I'm not blaming them. I'm just simply saying valuations don't matter. It's robotic.
Over the short run, you're right. Valuations haven't mattered across a reasonably finite number of companies. But at some point, over the long haul, valuation matters. And at $2 trillion, it's hard to see how you move that needle another trillion in market capitalization. So over the long run, valuation will definitely matter.